Committee's considerations. The committee took into consideration the continued slowdown in the global economy and the persisting uncertainties, including the ongoing trade wars between the U.S. and its major trade partners, financial fragilities in a number of countries, the debt-constrained fiscal operations of the most EMDs, including Nigeria, and the volatility in the on the oil market. Committee therefore enjoined the federal government to urgently build fiscal buffers through a more realistic benchmark oil price for the federal budget. The MPC noted the 2.01% growth in real GDP during the first quarter of 2019, compared with 1.89% in the corresponding quarter of 2018. Although output growth in the first quarter was slower than 2.38% recorded in the preceding quarter, it emphasized that actual output remains well below the economy's long-run potential, indicating the existence of spare capacity for non-inflationary growth in the economy, an opportunity which should be explored through increased credit delivery to the private sector. Not impressed by the flow of credit from the deposit money banks to the private sector, the MPC called on the CBN management to urgently put in place modalities to promote consumer and mortgage lending in the Nigerian economy, noting that doing this will greatly and positively impact on the flow of credit and ultimately result in output growth. The MPC called for a close monitoring of the uptick in inflationary pressures in April 2019, driven largely by food shortages during the Easter season, the commencement of the planting season, as well as persisting security challenges in some of the food-producing regions of the country. The committee urged the relevant authorities to strengthen efforts to address the security challenges and improve food production. It encouraged financial intermediating institutions to ensure that loans to the agricultural sector were channeled effectively to end users. The MPC welcomed the improvement in financial soundness indicators, but noted that although the non-performing loans ratio moderated, it remained above the prudential benchmark. Consequently, the committee considered and recommended to management a proposal to develop a comprehensive administrative, legal, and regulatory framework to speed up the recovery of delinquent loan facilities of the banking system, involving structured engagements with relevant stakeholders and authorities in order to mitigate credit risks and ultimately open up the credit delivery space in the Nigerian economy. The committee extended warm felicitations in an expression of gratitude to the President and Commander-in-Chief of the Armed Forces of the Federal Republic of Nigeria, President Muhammadu Buhari, and the Senate of the Federal Republic, respectively, for the reappointment and prompt confirmation of the Governor of the Central Bank of Nigeria, Godwin Emefiele, for a second 5-year term in office. In particular, committee noted that the reappointment was in recognition of the contributions of the Central Bank of Nigeria to maintaining macroeconomic stability, and it would engender confidence and build policy credibility and deliver stability to the Nigerian financial markets. The committee called on management to provide a mechanism for limiting deposit money banks' access to government securities so as to redirect bank lending focus to the private sector, noting that this will spur the badly needed growth in the Nigerian economy. It called on the government to use all machinery at its disposal to increase tax revenue to enable the government fund its budget adequately. Committee's decision. The global and domestic developments have conditioned an environment of low optimism in the macroeconomic and financial sector environments, forcing central banks to return to accommodative monetary policy. As in the past, the committee considered the options of whether to be more accommodative, tighten, or hold its position. The committee felt that although the slight inflation uptick should result in tightening, it nevertheless felt that doing this will limit the ability of deposit money banks to increase credit at this time, given the need to support or redirect the focus of the deposit money banks to new credits in support of consumer, mortgage, and other priority sectors of the economy, including the SMEs, agric, and manufacturing. It also felt that given the fragile state of the economy, increasing the cost of credit will further diminish investment flow and impact negatively on output growth. As regards loosening, some members felt that it was desirable to aggressively stimulate growth, restart the capital market activities, and increase lending at lower rates, which would ultimately stimulate domestic aggregate demand. Those against loosening felt that given that there was a marginal increase in headline inflation for April 2019, there is need to restrain from loosening in order not to exacerbate inflationary pressures. They also felt the economy would experience liquidity surfeit and without corresponding increase in real sector output, inflationary pressures could be elevated, resulting in likely exchange rate pressures. As for members who favored a hold position, maintaining monetary policy rate at its present level was essential for better understanding of the momentum of growth before determining any possible modifications. They also felt that retaining the current policy stance provides an avenue for evaluating the impact of the bank's intervention policies to support lending to the priority sectors of the economy. Consequently, the MPC decided against the backdrop of these developments by a vote of 9 members out of 11 to hold all parameters of monetary policy constant. 2 members voted, however, to reduce the monetary policy rate by 25 basis points. In summary, the MPC voted 1 to retain MPR at 13.5%, 2 retain a symmetric corridor of plus 200 and minus 500 basis points around the MPR, 3 retain CRR at 22.5%, and 4 retain the liquidity ratio at 30%. I thank you for listening.